cements his brand worldwide.
Hello, welcome to Business 360. I'm Parikshit Luthra, and here are the headlines we are tracking this evening. Stock markets fall for the third straight session. Sensex falls over 500 points and Nifty loses nearly 150 points. Rupee weakens marginally against the dollar to move closer to the 82 mark. The industry gives a thumbs up to the government's decision to scrap export duty on iron ore and several steel products. Minister Jyotiraditya Scindia says that removal of export duty will lead to a new era of growth for the steel industry. The union government could reassess the national monetization pipeline goal, make it more realistic. Sources say government may reassess the accruals, may refocus on monetizing idle assets instead of running ones. The Finance Ministry tells a parliamentary panel that the timeline for becoming a $5 trillion economy has been postponed by 2 years to 2027 due to the pandemic. Adds that real GDP growth is expected to hover around the 6.5 to 7% mark this fiscal, and inflation would enter the 2 to 6% tolerance band by the fourth quarter. Former bureaucrat Arun Goyal takes charge as election commissioner, fills the third and final post that had been lying vacant for 6 months. Goyal is next in line to succeed CEC Rajiv Kumar when he demits office in 2025. Mixed reactions to the COP27 climate summit as the world's biggest economies make fresh commitments to cut greenhouse gas emissions. Developed nations agree to compensate poorer ones suffering due to climate change. But many world leaders call this a small step towards climate justice. In a surprise announcement, Bob Iger returns as the CEO of Disney 11 months after leaving the company. Bob Chapek exits Disney after a tumultuous period at the helm. Former US President Donald Trump snubs Twitter after Elon Musk announces the reactivation of his account. More than 15 million Twitter users voted in a poll conducted by Elon Musk, where nearly 52% favored the return of Trump. Straight to the day's market action. Dalal Street saw red for the third straight session amid growth concerns. Nifty and Sensex fall close to 1%, with the Nifty ending below the 18,200 mark. Broader markets fared better, but ended mildly lower. Prashant Nair is here with the wrap of the day's trading action. Prashant, over to you.
The market did come off today. It was looking like it will for the last many sessions, and today we lost about 0.8% in the Nifty. The banks did better, and largely because of PSU banks, and I'll come to that in a bit. Large losses in IT services, real estate, and energy as a pack. Energy, of course, because oil prices have come off. The exceptions, as I said, were PSU banks, which were up. I'll come to names in a bit. And you also had small caps. Although broader market breadth was negative, small caps did better. ONGC was a top loser with, of course, direct correlation with what's happening with oil prices, which are going down. Adani Ports, Hindalco, TCS, etc. A few other heavyweights which were down. Only 3 names with gains in excess of 1% in the Nifty: BPCL, Bharti and Axis Bank. There were 2 listings, interesting price action. One opened sharply lower but ended higher. Both actually by close were higher in trade. One a chemical company, the other an NBFC. Broader market cuts coming through in Zomato and Nykaa, which continue to go down. Defense names are seeing pullback. So Mazgaon and Kochi Shipyard both lower. Adani Green, Lodha and Kim's Hospital chain were some of the other cuts today. Gains coming through in Escorts. The company held an analyst day. Markets like what they heard. IEX, Godavari Power, UCO Bank Central and IOB from the PSU bank space doing pretty well. Are we starting to see some pullbacks in global risk-on moves as well? And I think that's the relevant question here. For the Nifty, the 20-day, which is about 60-70 points away from where we closed yesterday, becomes important, a level which bulls must defend if buying has to come back in the near future once again.
All right, thanks very much, Prashant, for joining us. Now to a CNBC-TV18 news break that has been confirmed. The government has withdrawn export duties on most steel and iron ore products that were levied in May this year. Shireen Bhan spoke to Steel Minister Jyotiraditya Scindia on the decisions and its likely impact.
Well, the government has decided to remove the export duties that were imposed on steel and allied steel products. The imposition was done in the month of May, and the decision to remove these duties with effect from the 19th of November has come in over the weekend from the government. Joining us now to explain the rationale behind the timing of this move and discuss other matters related to the steel sector is the Steel Minister, Jyotiraditya. Mr. Scindia, always a pleasure. Many thanks for joining us here on CNBC-TV18. Let me start by asking you about the rationale behind the timing. It is no secret that the industry has been asking for a removal for months now. Negotiations have been on between industry, the finance ministry and the steel ministry on when and how to do away with these export duties. What prompted the decision as far as the timing is concerned, Mr. Scindia?
Well, if we, first of all, let me just qualify your question by saying when you said that for months now, let's not forget that the imposition of this export duty has only been in place for months now. So we started on the 2nd of May, basically month of June onwards. So it's imposed only for a period of 5 months. So it's not as if this export duty has been in place for years and the discussions have been going on for months for the removal. The whole span has been from the 22nd of May to the 19th of November, which by itself is a period of just about a little over 5 months. Having said that, when I took over in mid-July, I had started the discussions with both the advisory committees that I had set up. One is the Integrated Steel Plants Advisory Committee, and the other is the Secondary Steel Industry Advisory Committee, which both comprise of the production areas in the steel industry. And it's only after many iterations of discussions and very long deliberations that we arrived at the conclusion that we are in favor of lifting these export duties. Please do understand that just like civil aviation, the steel sector also goes through a seasonality in terms of demand requirement. So we were in the month of July in the monsoon season, which is the most sort of lull period for demand for the steel sector, understandably, because construction and everything else comes to a halt. And therefore, through that period of iterations and deliberations, we took a conscious decision with all hands on deck. The steel industry, government, whether it's the steel ministry or the coal ministry, the finance ministry, that we would watch how the steel prices react when demand starts taking off in the festive season. And once we have some sort of confidence level that steel prices are not again going to go on a northward trend, then we will certainly evaluate this. That's point number one. Point number two, we were also tracking raw material prices, because as you're aware, iron ore and coking coal form almost about 60 to 70% of the production cost for the steel majors as well as for the secondary steel sector. And those commodity prices, after reaching a peak, had started falling tremendously. And we were apprehensive that maybe those prices also, as international forecasters had put in place, may start rising again. So there would be multiple pressures on the steel industry with regard to pricing. And so we were dynamically monitoring that. And I had committed to the steel industry that we will take a view one way or the other in the month of November. And in the month of November, through our multiple deliberations with the Coal and Mines Ministry, with the Home Ministry, with the Commerce and Industry Ministry, and finally with the Finance Ministry, we took that view that the time has come now that we need to remove this export duty. Both, let me emphasize, with regard to the steel industry and the steel sector with respect to the 9 HSN codes, but also in terms of the raw materials, which is iron ore greater than Fe content of 58, less than Fe content of 58, as well as pellets. So the move has been across the board vertical integration from raw material to finished product, where in the case of iron ore, it has been removed completely in the area of less than 58. Greater than 58, right. It's been reduced from 50% to 30%. Pellets have been removed completely. And the 9 HSN codes for steel products, the 15% export duty has been removed completely.
Yeah, you talked about how there have been deliberations on interministerial deliberations as well as deliberations with industry, and finally the government deciding to take this call in the month of November. Mr. Scindia, I want to understand from you, in your conversations with industry, what is the feedback in terms of inventory build-up, inventory pile-up, and now destocking on account of the export duties being reversed? What is it that industry has left on your table by way of feedback? Because it's also a globally challenging environment that the steel industry is currently faced with. If I were to take a look at the numbers, Nomura has put out a report on how exports are down 66% between April 22 to about October 22, and in fact at the lowest monthly level of exports since May of 2016. So it is a challenging environment. What did industry place on your table by way of feedback?
So if you look at the international environment, in which I include India, at this point of time, the commodity cycle peaked about 2.5 months ago. And since then, whether it's coking coal or iron ore, prices have fallen off with regard to raw materials ranging between 30% to almost 55% in terms of value. Coking coal has come off from $600 to almost $300. So raw material prices have come off exponentially. On the other hand, steel pricing is governed by 2 factors. One is the raw material input costs into steel making, and the second is based on demand pull and therefore impacting supply push. Now, internationally, demand pull has contracted tremendously for multifarious reasons, which you must have elaborated many times during your show for all commodities worldwide. The fact that many economies are quote unquote near recessionary trends, the fact that infrastructure spend in many international economies has actually fallen, the fact that China has also not been able to ramp up demand. But conversely, the situation is very different in India. If anything has kept the steel sector going as far as India is concerned, with a capacity of almost 150 million tons per annum and a production of almost 121 million tons per annum, it's actually the domestic demand, driven by Prime Minister's huge push on infrastructure. The fact that public spending on infrastructure is close to about 10 lakh crores this year. The fact that there is a very robust demand cycle, which after decades has hit almost about 10.6% in terms of increase in demand for steel. And therefore, the domestic demand, what is shoring up steel industry to a great extent. As far as the export market is concerned, understandably that those export numbers are going to be falling exponentially from May till October because of the export duty. But I do believe that 15% of India's production prior in 21-22 was exported internationally. Our companies, both ISPs as well as some SSIs, have got a foothold in international geographies, from Europe to the Middle East to Southeast Asia. And I believe that this step will allow them to again gain that or maintain that foothold in those international markets. It takes a lot of time to seed those customers, and it's very important for us strategically in India to be able to retain those international customers as well. So I think that even though dividends may not come immediately, because there is huge pricing pressure internationally as well, if I take the example of power, fortunately the steel sector in India has a committed base load of demand of almost 80-90% of steel production from domestic sources. And the balance 10-15%, the top up or the cream, if you may say, is only one that is targeted to the export sector, which I believe in time our companies will again regain in the days to come.
Yes, we'll have to see how much of that is reclaimed and how soon and quickly it is reclaimed. But Mr. Scindia, I want to address the issue of the PLI scheme because you spoke about it this morning, saying that 70 plus applications have come in for the specialty steel PLI scheme. But given the situation at this point in time, when do you anticipate that we are actually going to see investments taking off? Because demand visibility will also be crucial in terms of capacity addition.
So therefore, to your somewhat, if I may be positive, your realistic note, let me not call it a pessimistic note, but to your realistic note, let me say this, that we have got a firm commitment for capacity addition of 26 million tons per annum through the tenure of the PLI scheme, close to about 46,000 crores in terms of investment. Almost creation of 69,700 odd direct jobs, applications, 79 applications from 35 companies, of which 62 applications have been approved. So therefore, it's very, very heartening feedback for the specialty steel sector, which will in many ways be value additive from a product point of view for the steel sector. So we are very positive and very hopeful. We see that capacity coming on stream in chunks as we proceed over the next couple of years.
Okay. Let me address the other PLI scheme that also falls under your purview, and that is the drone PLI scheme, which was also rolled out after consultations with you and the Finance Ministry. Can you give us an update on where things currently stand as far as the drone PLI scheme is concerned, Mr. Scindia?
We've seen a tremendous amount of interest in that as well. The turnover of those companies from a very small number of roughly 60 crores odd has grown to almost close to a 200, 250 crore turnover number. The PLI output out of the PLI scheme has also been dispersed to a degree of almost about 40-50%. And that is a sector which is really undergoing exponential growth. In fact, as we speak, I have coordinated with close to about 14 parallel ministries in Government of India in terms of requesting them, urging them to increase their activities through drones. A lot of the ministries have used very innovative processes. And a similar exercise I have done with the 36 states and union territories, where we have mapped out best practices, best industry practices, and exchange best practices between states so as to bring them on board in terms of various applications for drones. So it's a very wholesome approach to the drone policy, where we are acting as a facilitator and a collaborator between the center and state governments, pushing demand through both state governments and central government, as well as in the retail side through sectors like agriculture and others.
All right, Mr. Scindia, we leave it there. Appreciate you joining us today to take us through both these decisions, the decision to remove the export duty on steel, as well as reimpose the import duty on some products like coking coal, as well as give us a status check of the PLI schemes that you are currently tasked with taking forward. Always a pleasure. Appreciate your time. That's the Minister for Steel, Jyotiraditya Scindia, taking us through the government's decision to do away with the export duty imposed on steel and steel products on the 22nd of May.
All right, that was Jyotiraditya Scindia, the Aviation and Steel Minister, speaking to Shireen Bhan about the government's decision to remove the export duty on steel. Remember, this had been imposed in the month of May and had been a demand, a big demand from the industry to revise, because they felt that the removal was necessary to increase manufacturing, increase exports as well. Let's get you another big story. This is again coming from the steel industry after the announcement by the Finance Minister on removal of steel duties. The industry has given a thumbs up to the government's decision to scrap export duty on steel and iron ore. Danish Anand gets us the feedback from the steel industry.
as the economy is bouncing back from the pain imposed by COVID, the government last week gave a major relief to the steel sector by removing export duty on certain items. Well, this had been a long-standing demand of the industry, and the government feels that this will lead to a new era for India's steel sector. Well, this is what the major industrialists from the steel sector had to say.
We expect this demand and requirement to continue, but is there any concerns for the future? Yes, it's absolute yes. We have to be vigilant about the changing expectations from the steel industry as the country marches forward in the infrastructural growth.
Winter time generally for European countries, US countries, export market, if I can say, is generally at a slowdown pace because they're looking at destocking mode. But we feel after January onwards again the export market should pick up.
Right. So very lastly, what are your expectations from the upcoming budget? Is there a particular wish list that you have in mind?
So one thing was definitely the removal of export duty. The other request would be that any kind of dumping that is happening in the country which relates to steel, stainless steel, that should again be looked at by the government in a favorable manner and take some action according to that.
I would say over the last 6 months, demand in steel in India has held up actually the steel industry, while exports was not there. The international demand has been impacted, one because of the pandemic, followed by the war, and the high energy cost as a consequence of the pandemic and the war is resulting into some de-acceleration in the demand in many parts of the world. But we expect that to be sorted out probably as we go along into the next year.
While the industry is happy with the latest government announcement, but still there are many challenges in the future as currently the international demand is low and it is majorly the domestic demand which is keeping the steel industry running. The industry expects certain announcements from the government in the upcoming union budget, and the industry feels that there should be some announcement on anti-dumping of stainless steel, there should be some announcement on demand generation, and they are seeking a clarity on green steel, decarbonization, and how the government will help the industry in energy transition. With video journalist Rajinder Singh Raina, this is Danish Anand for CNBC-TV18.
All right, we're going to take a short break now, but coming up, the union government could reassess the national monetization pipeline goal, make it more realistic. Details when we're back. Welcome back. You're watching Business 360. The IMF recently lowered its global growth forecast for next year to 2.7%. Based on key economic indicators, the IMF has said the outlook for G20 economies is a gloomy one. High inflation, weakening of the Chinese economy, and the Ukraine-Russia war are weighing down the world economy. Amid global headwinds, the Parliamentary Committee on Finance today sought views from the Finance Ministry and Niti Aayog on the roadmap to a $5 trillion economy. So what did the government tell the parliamentary panel? Top government officials have briefed the parliamentary panel on India's roadmap for a $5 trillion economy. Sources say the government has said the real GDP growth is expected to be between 6.5% to 7% in FY23. Inflation to enter tolerance band of 2 to 6% by Q4 of this fiscal. Urban unemployment rate, which is at 7.6%, to fall further by end of fiscal, and private capex cycle could commence in FY24. Among the headwinds to India's growth path, pressure on currencies to depreciate against the dollar will persist into 2023. Loss of world output and trade could impact India's growth. Continued high crude prices will dilute domestic stimulus to growth, and food inflation could worsen due to climatic conditions. Now, the timeline for India becoming a $5 trillion economy has to be postponed because India has lost 2 years of growth. The $5 trillion target can be achieved by 2026-2027. For this, 6.5% annual growth rate is needed, and inflation should be below 6% and US inflation closer to 3%. Now, what are the key reforms needed to cross the $5 trillion target by 2026-27? Officials have told the parliamentary panel that on the agriculture side, you need land consolidation, facilitating crop diversification away from food grains into edible oils. On the power side, increasing user charges, improving DISCOM viability and reliability of affordable power for MSMEs, improve capacity of state governments to undertake local infra spending, reduce compliance burden on MSMEs from state, local and union governments, focus on asset monetization and privatization, reduction of government debt stock and lower cost of capital. Now, these were some of the key reforms that the Finance Ministry briefed the parliamentary panel about, which could really help India's transition to a $5 trillion economy. Back to you. Now, the union government, we're learning, could reassess the national monetization pipeline goal, make it more realistic. Sources say government may reassess the accruals, may refocus on monetizing idle assets instead of running ones. Sapna Das joins us with the latest.
That's right. What we're getting to pick up is the fact that some kind of rejig within the national monetization pipeline is very much likely. This pipeline is worth around 6 lakh odd crores. That has been the government's aim. It was launched way back in September 2021. But some of the excitement emanating from this pipeline and the monetization of assets, that seems to have kind of, withered away, so to speak. So we're given to understand that a rejig is on the cards. Trying to make the pipeline and its goals more more realistic. Probably within that, I think the government, rather the centre, will also look at it in terms of how much will be accruing to them, because once you have a monetization pipeline, it's a three-way sharing of resources between the state governments, the companies, of course, which are doing the monetization, and some bit of it comes to the centre. So all of that is going to be part of this realignment that we are talking about. Of course, in terms of the 6 lakh crore number, that looks a bit fancy and a bit difficult to meet. But at the moment, at least, the centre will be sticking to that. Also, in terms of the laggards, well, railways were supposed to be the second largest contributor to the national monetization pipeline. It has not really met that goal, so to speak. Of course, it's roads that has been the largest contributor. Surprisingly enough, coal has also come up fast, but here lies in the problem. Basically, the monetization pipeline was meant to, invigorate life into those assets which have been lying idle, and not to kind of just talk about assets which are already running, and that's what is happening. So probably all the dead weight will be shaken off at some point in time. Maybe we can see some announcements coming up in the budget, so to speak. Last year, we do know that the monetization aim was met. It was somewhere around 88,000 crores. I think the government exceeded that. This year, the aim is around 1.62 lakh crore. We are given to understand anywhere between 1.25 to 1.50 lakh crore would be coming in. But again, the question remains, how much of that will come to the centre? So all of this is going to form part of the larger realignment that we are talking about, and some announcements likely in the budget.
All right, thanks, Sapna, for getting us that big breaking story. With that, it's a wrap on this edition of Business 360. Thanks for watching. Stay tuned to CNBC-TV18. News continues on the other side.